Hello everybody. Today our group are going to present three chapters, chapter 9, 10, and 11, about international financial system, foreign exchange market, and international monetary system and global capital market. Here's a bit of outline that we are going to discuss. We are going to discuss the function of foreign exchange market, the economic theory of international foreign exchange value determination, gold standard, the Bretton Woods system, the fall of the fixed exchange rate system, and floating exchange rate system. First of all, I'm going to explain the functions of the foreign exchange market. Before explaining what is the foreign exchange market, the foreign exchange market is simply a market where we can convert or exchange one country's currency into another country's currency. And in the act of the converting, there is what is called exchange rates. Exchange rates are the rate of one country's conversion to another. So what are the functions of foreign exchange market? The first is for currency conversion, and the second is for insuring against foreign exchange risk. So in currency conversion, there are tourists and companies in international trade or investment. Companies usually deal with payments companies receive from exports, payments companies give for products and services, and spare cash that companies have to invest in foreign companies. And then there are currency speculation, which is basically a type of investment that involves short-term movement of funds from one currency to another in hopes of profit. For example, if we want to buy maybe US dollars because we think that it will increase in exchange rate, so we can buy it now and sell it later for profit. And then there is the insurance against foreign exchange risk. So foreign exchange risk is basically there is a possibility that unpredicted change can happen in the exchange rate that might occur, which will have consequences for a firm in maybe investing or maybe in the business. First, there is spot exchange rates, which is the price or exchange rates that happens on the spot when we try to exchange the currency. And then there's forward exchange rates, which is the exchange rate that happens in the future. If maybe we want to buy in the future, the exchange rate is called forward exchange rates. And currency swap is basically swapping between spot exchange rates and forward exchange rates. Next, I'm going to explain the theory of international foreign exchange value determination. So, prices and exchange rates can determine the value of the currency. Before explaining that, we have to know the law of one price. The law of one price is basically states that the price of an identical product in different countries shouldn't differ significantly. For example, the value of Big Mac over here and in the United States shouldn't differ significantly. And with the law of one price, there is a purchasing power parity, which is where we compare the product from here and America. Example, maybe the Big Mac price over here and America, we compare it and then we can determine the exchange rate. And money supply and price inflation also can determine the value or price of the currency. Next is interest rate and exchange rate. So basically, interest rate also can determine the value of a currency. And there is an effect called the Fisher effect, which states that a country nominal interest rate is the sum of the required real rate interest and the expected rate of inflation over the period for which the funds are to be lent. There's also called bandwagon effect that can affect the price, which occurs when a herd of investors are heading the same direction, which causes the price of the currency to experience appreciation or depreciation.
So next, I will explain about the gold standard. Next. So what is gold standard? Gold standard is the use of gold coins as a medium of change, unit of account, and store of value. At first, gold coins used by many countries for their trade. And then shipping large quantities of gold and silver around the world to finance international trade seemed ineffective. So the solution adopted was to arrange for payment in paper currency and for government to agree to convert the paper currency into gold on demand at a fixed rate. Next. So the mechanism of gold standard is at 1890, countries that do trade use gold as their medium of exchange. Then the exchange rate easy to determine. Example, $1 was defined as equivalent to 23.22 grains of pure gold. So the strength of the gold standard is contained a powerful mechanism for achieving balance of trade equilibrium by all countries. Next. So this is the period between the wars when the gold standard is applied. First, the gold standard worked reasonably well from the 1870s until the start of the World War I in 1914 when it was abandoned. Then country printing more money and caused inflation in 1918. The United States returned to the gold standard in 1919, Great Britain in 1925, and France in 1928. Then the Great Britain pegging the pound to gold at the pre-war gold parity level of 4.25 per ounce, and it was out of foreign market, which pushed the country into a deep depression. The net result was the shattering of any remaining confidence in the system. This put pressure on the gold reserve of various countries, forcing them to suspend gold convertibility. By the start of World War II in 1939, the gold standard is no longer in use. Next. So the next period is the Bretton Woods system. Next. In 1944, a representative from 44 countries met at Bretton Woods to design a new international monetary system. The agreement reached at Bretton Woods established two multinational institutions. The first is International Monetary Fund, and the second is World Bank. Another aspect of the Bretton Woods Agreement was a commitment not to use devaluation as a weapon of competitive trade policy. Next. So the role of IMF is the main custodian that it has to principle when the first is discipline. It is the need to maintain a fixed exchange rate, puts a brake on competitive devaluation, and brings stability to the world trade environment. Then the second is a fixed exchange rate regime imposes monetary discipline on countries, thereby curtailing price inflation. And the second is flexible. So the IMF stood ready to lend foreign currency to members to tide them over during short periods of balance of payment deficits. Countries were to be allowed to borrow a limited amount from the IMF without adhering to any specific agreements. The system of adjustable parities allow the devaluation of a country's currency by more than 10% if the IMF agree that a country's balance of repayment was in fundamental disequilibrium. So the the second institution is World Bank. So before we know World Bank, it was called International Bank for Reconstruction and Development. The bank's initial mission was to help finance the building of Europe's economy by providing low interest loans. As it turned out, the World Bank was overshadowed in this role by the Marshall Plan. Then the bank turned its attention to development and began lending money to the third world nations. And in the 1950s, the bank concentrated on public sector projects such as power station, road building, and other transportation investment. So the bank lends money under two schemes. The first is under the IBRD schemes, when money is raised through bond sales in the international capital market. The market rate is lower than the commercial bank's market rate. The second scheme is overseen by the International Development Association or IDA. Uh, the IDA loans go only to the poorest country. Borrowers have 50 years to repay at an interest rate of 1% a year, and the world's poorest nations receive grants and interest-free loans. Next.
Okay, thank you, Rafi and Elizabeth, for your explanation. Now I'm Rafael, and I will continue the presentation to the next learning objective, the fall of the fixed exchange rate systems. Next, please. So before we go to the why fixed exchange rate is collapsed, we should know what is the fixed exchange rate. So fixed exchange rate is a regime applied by a government or central bank that ties the country's official currency exchange rate to another country's currency or the price of gold. So the purpose of a fixed exchange rate system is to keep the currency values within a narrow band. And fixed exchange rate provide greater certainty for exporters and importers and help the government maintain low inflation. And last one is many industrialized nations began using the floating exchange rate system in the early 1970s Fixed rates also help the government to maintain low inflation because which in the long run they keep interest rates down and stimulate trade and investment. Next, please. So what makes the system collapse? The system collapsed in 1973, and since then, government had managed using the floating system, which we are going to discuss next. So they use dollar as the only currency that could be converted into gold, and as the currency that serves as the reference points of all others, has occupied a central place in the system. And because of that, any pressure on the dollar to devalue could wreak havoc within the system. So most economists try to trace the breakup of the fixed exchange system in the U.S. macroeconomic policy in 1965 until 1968. Uh, to finance both the Vietnam conflict and his welfare programs, President Lyndon Johnson backed an increase in United States government by spending that was not financed by an increases in tax. Instead, it was financed an increase in the money supply, which led to rise in the price inflation from less than 4% in 1960 to close to 9% by 1968. At the same time, the rise in government spending had stimulated the economy. With more money in their pocket, people spend more, particularly on imports, and the United States trade balance began to deteriorate, which is why the strong reason why the system is collapsed. Next. Okay, so for the next one, we are going to discuss about the floating exchange rate regime that changing the system. Okay, next. So what is the floating exchange rate regime? Floating exchange rate is a regime where the currency price of a nation is set by the foreign exchange market based on supply and demand relative to other currencies. This is in contrast to a fixed exchange rate in which the government entirely or predominantly determine the rate. Okay, next. So for the main point of this learning objective, the first one is a floating exchange rate is one that is determined by supply and demand are on the open market. Uh, Next, fixed exchange is another currency model, and this is where a currency is pegged or held at the same value relative to another currency. The third one is a floating exchange rate doesn't mean countries don't try to intervene and manipulate their currency's price. The last one is the floating exchange rates became more popular after the failure of the gold standard and the Bretton Woods Agreement, which is we have discussed before. Next, please. So there are two things that related to the floating exchange rate. The first one is the Jamaican Agreement. Main element of this agreement is floating rates were declared acceptable in that year. The second one is gold was abandoned as a reserve asset, and the third one is the total amount of member countries contribute to the International Monetary Fund or IMF were increased to $41 billion. Uh, the second one is the exchange rate since 1973. There are unexpected shocks to the world monetary system, which is um, oil crisis when OPEC quadrupled the price of oil in 1971 and 1979. Sharp rise in the United States inflation rate between 1977 until 1978. And the last one is partial collapse of European monetary system in 1992. Okay, next. Okay, so how does the floating exchange rate works? The floating exchange rate system means a long-term currency price change to reflect relative economic strength and interest rate differential between countries. The short-term move in a floating exchange rate currently reflects speculations, rumors, disasters, and everyday supply and demand for the currency. If supply outstrips demand, that currency will fall, and if demand outstrips supply, that currency will rise. Please say it first. So the extreme short-term moves can result in intervention by central banks, even in a floating rate environment. Because of this, while most major global currencies are considered floating, central bank and government may step in if a nation's currency becomes too high or too low. Okay, next please. Okay, so this differentiation between the floating versus the fixed exchange rate. The floating rate is usually determined by the open market through supply and demand. Therefore, if the demand for the currency is high, the value will increase. If the demand is low, this will drive the currency price to the lower state. And on the fixed exchange rate, fixed or peg rate is determined by the government through its central bank. The rate is set against another major world currency, such as the United States dollar, a euro, or yen. To maintain its exchange rate, the government will buy and sell its own currency against the currency which is it fixed or pegged. And some countries that choose to peg their currencies to the United States dollar include China and Saudi Arabia. Okay, next. China and Saudi Arabia. Okay, for now on, we will move forward to the case study.
So first, I am about to answer the first question. The question is, why do you think the Chinese government originally pegged the value of the yuan against the US dollar? What were the benefits of doing this for China, and what were the costs? So, we believe that the Chinese government pegged its currency against the US dollar because the US dollar is one of the most stable currencies there is. And there are advantages in this act, mainly in export and trades. With China's low production cost and US strong currency, US companies tend to produce their products in China because they have low production costs and low labor costs. So it can make larger profit. But it also has some disadvantages, like the one mentioned in the case, which is excess foreign exchange reserves that can cause inflations.
Okay, so for the second question is, over the last decade, many foreign firms have invested in China and used their Chinese factories to produce goods for export. If yuan is allowed to float freely against the United States dollar on the foreign exchange markets and appreciate in value, how might these changes affect the fortune of those enterprises? So there are two answers for this question. The first one is because of the globalization, many foreign companies start to invest their money in China because of their low cost production facilities and also cheaper export of manufactured goods. To leverage the strong value of the USD, China pegged its yuan against USD at value of $1 equal to 8.28 yuan, which is leads to the discussion about the impact on these companies with China allowed the free float yuan and its value appreciate. And for the second one is if the China is considered as a low cost country due to easy and cheap availability of raw materials and low labor wages. China will allow the free float of yuan, and if yuan appreciates, then the currency will be relatively stronger with the USD. It would have reduced its competitiveness for cheap export, and also this might also result in declined production capacity and reduction in employment rate. The labor cost will increase, and also due to the appreciation of yuan, it would be detrimental for foreign enterprise to invest in China as it increase their costs by reducing the profit margin of the production.
So I will answer the third question. The question is, how might a decision to let the yuan float freely affect future foreign direct investment flows into China? So with the floating exchange rates, if the yuan applies the floating exchange rates, that makes the exchange rates of the yuan very unpredictable and uncertain whether it is stable or not. The uncertainty will make foreign investors hesitate to invest in China's company. But if the yuan turns out to be stable enough, it can increase foreign direct investments.
So the fourth question is, under what circumstance might a decision to let the yuan float freely destabilize the Chinese economy? What might the global implication of this be? So uh, when the yuan float freely can destabilize the Chinese economy in this situation. So the free floating yuan can increase the value of China's currency and lower the demand for export. Lower demand for export means lower jobs available and thus higher unemployment that can cause economy destabilization. And float free yuan can lower demand on the global market because nowadays world economy relies on China. If China no longer provides for the world, all of the other countries' economy will suffer. Also, Chinese manufacturing will slow as companies lose benefits of cheap yuan's export. A rise in of Chinese yuan means raising everyone's living costs in exchange and will give big inflation to the countries that depend on China's products.
For the fifth question, the question is, do you think the United States government should push the Chinese to let the yuan float freely? Why is the reason? So, from our group perspective, I think instead of pushing the Chinese yuan, the government can explain and discuss about the benefits such as decreasing decreasing price of imports, increasing purchasing power of consumer. More valuable yuan would shift growth and make it more consumption driven. And the last one is a stronger currency could decrease inflationary pressures, which are now being seen in several Chinese markets.
So the last question is, what do you think the Chinese government should do? Let the yuan float, maintain the peg, or change the peg in some way? So according to our group, we believe that it will be a good choice for the Chinese government to maintain the peg. As long as a currency peg keeps the yuan low relative to the other currencies, consumers using foreign currencies can buy more of China's exports than they would if the yuan more expensive. Although opponents of yuan pegging have complained, they may be oversimplifying the situation. An artificially low yuan is not without its benefit. The currency peg means cheap Chinese goods for other countries' consumers, a development that can help keep overall inflation at a modest level. Other benefit is companies that use less expensive imported items from China to make goods enjoy reduced production costs. With lower expense, firms can either lower the price for consumers and increase their profits. So that's all from our group. Thank you.